Welcome back. Are you looking for some absolutely fantastic opportunities here to buy some dividend stocks, but you're not quite sure what you're looking for, or you were a little bit worried about the risks? If you're a long-term investor, stick with me today. We're going to look at two amazing real estate investment trust REIT opportunities. And we're going to look at some of the upside benefits as well as some of their sort of predictability, which I think is personally really important for an investor who's in it for the long term. Now, you might still be a little bit risk averse. If that's you and you're a little bit worried about investing your money in the market, stick around till the end and I'm going to share an interesting and little known element of the market here that's going to both reduce your risk and give you good income at the same time. So let's get into it. Two nice options. Now, one of these is going to be the big one, the granddaddy, the bad Realty Income O. Many people do know this. It's one that I hold myself in the portfolio. It's one of those sort of really stable, slow growers. Now, the other option that we're looking at today is simply known as Agree Realty. Now, ADC, this is a relatively newer REIT. It follows the same type of model and the same type of approach as Realty Income. But it does have some interesting elements here to look at. So we're going to look at Agree Realty first. We're going to then switch gears and sort of compare both of them as well to try and find out which might be the better options for us today. All right, so Agree Realty. Now, as you can see here, this is the April 2023 investor presentation. We can get a sense here for the type of organizations that they are providing the real estate options to. These are big names. If you don't come from the US, you probably still recognize most of them. Now, when you begin to think about what this means, it means that the people who are paying for the space that Agree Realty provides, these people, these companies, they're not going away anytime soon. Now, founded about 5 decades ago, they have been providing a very consistent benefit here for investors, and one of the key things here as well is also getting an investment grade issuer on their bonds as well, which is really important to think about. Some of the recent highlights here, and I want to draw your attention to a couple of the major benefits here. They've got the ground lease portfolio, which is an important baseline for them as well. That represents about 1/8 of their overall base rents. They've got a relatively low level of debt to the recurring EBITDA as well, which is important. The cash dividend has been going up at a fairly consistent mid-single-digit pace here. So again, the most recent dividend increase has been 5.7%. We're going to get into the benefits here for dividend investors soon. Now, as I said, their tenants are not going away. You begin to look at the investment grade or the creditworthiness of these tenants, and we begin to get a sense that they are indeed big, large, well-run organizations that are not disappearing anytime soon. So 2/3 of their tenants, the retailers here, are investment grade. Some of them are sub-investment grade. These others are not rated, but are going to still be fairly good tenants for them. One of the things that I really have enjoyed looking at here is their increase in the investment activities. So they've actually made some pretty substantial purchases over the last decade, really. And this has been ramping up, particularly, I think, taking advantage of their financial strength and sturdiness during and after the pandemic. It's also important to note that they don't just sit on property. They actually have been focusing on getting rid of some of the assets that don't any longer really fit with where they want to be and where they're going. And so we can see here from this slide in the invest presentation that they've really focused on streamlining, removing some of the assets that no longer fit, and then cycling this capital back into assets that do represent a much better fit for them. And this is really, really important. They have a very strong, a very powerful balance sheet. And I wanted to show a couple of quick slides here from the investor presentation that I think are really important to look at. Number one, we see here virtually no debt maturities until 2028. Now, what this means is that even if credit and interest rates went wild for the next several years, it's not going to have a material impact on Agree Realty. And that's really important as well. The overall capital markets track record, we can see here that they've got some unsecured debt, mostly common equity, and there is some preferred equity, and this is something that we're going to look at next as well. And this is a beautiful chart. Essentially 6% 10-year compound annual growth rate in the monthly dividend. So there's a lot of benefits here. Monthly dividends are very powerful for us. First off, I very often do enjoy looking at this general historical chart here to get a sense of how the organisation's doing. Now we can see here, obviously, post-global financial crisis, there were a few issues there. We can see in the white line here, there was a bit of a dividend cut going on. But basically, since about 2012, we've seen this absolutely beautiful, generally steady increase here in the FFO, the funds from operations. Now I have here the FFO, which is essentially the same as the earnings for a REIT due to the differences in how sort of REITs operate and how they manage their costs. Now there's a couple of key points here that I want to look at. Number one, analysts. Do the analysts have a pretty good sense of what's going on with this organisation, and do they normally get it right? So we can see here when it comes to the funds from operation, looking at a 1 year forward estimate for the analysts, they get it right about 92% of the time, and the company beats their expectations about 8% of the time. 2 years forward, the analysts get it right 100% of the time. Now, obviously, this is a reasonably wide margin of error here as well, but it's also important to note that fundamentally, the company both provides good guidance and is operating in a fairly stable way, which is important, I think, for me as an investor. Now, historically, what does this look like? So I'm turning over here to the overall performance to get a sense of how the company's been doing. Now, one of the things, as I noted visually on the chart, is since 2012, I wanted to have a look at how they've been performing here in terms of these dividend increases. And we can see here strong single-digit increases. One of the beautiful things here as well on fast graphs is it gives us an overall annual compound growth rate here and compares it to an investment in the SPY, the S&P 500 ETF at the same time. Now we can see here that there has been an overall slightly higher compound growth rate. Now this is obviously going to be partly determined by the exact starting date. So here I've just got the full historical data available for ADC. To make it a reasonable comparison, so I haven't sort of cherry-picked a date here to make them look good. The annualized rate of return, though, without the dividends is slightly lower than the S&P 500, which sort of, again, indicates and outlines the importance of the dividends here in terms of the total returns. In terms of the total returns, we would have seen the dividends here paying out over this period $24,000 on a $10,000 investment, compared to the S&P 500's $8,000. So overall, it looks like it hits my benchmark as a reasonable potential investment here. Now, for the forecasting, I'm going to switch over to the normal multiple. Over the last 5 years, they have had a price to FFO, sort of like the PE ratio of about 20 times. That's suggesting that it is a well-regarded company with reasonable growth rates expected and a strong balance sheet. And that's what I would expect to see is a PFFO ratio that's higher than 15 under those circumstances. Now, a couple of key points here. The dividend yield is relatively, it seems almost low at 4.4, and we can see here in the blue line this price to FFO and the normalized price of about 20 times. We can look at the analyst estimates down below. Now we can see that over the last 6 months these analyst estimates have been revised downwards, but only really a small fraction for both the 2023, 2024 and 2025 years. So that's really encouraging to see. Now, if prices return to the price to FFO ratio and the analyst estimates for FFO ratio outcomes are correct, we might be seeing potentially till the end of 2025 a 3% rate of return, which represents an annualized rate of return of about 14%. Now, given that they have a very strong balance sheet, given that they're very successful, I think, in terms of that overall active management of the portfolio, I think this represents a really interesting opportunity for us. Okay, so I want to take a look at Realty Income Corporation. So this is a very large REIT. It's well respected, and of course they pay monthly dividends, which is always attractive. So look, an A- S&P credit rating, not to be understated. That's really important and useful. And it's got a near 5% dividend yield at the current prices. But first, a quick look at their overall performance. So orange line here represents about a 15 times, or what you might consider to be a roughly normal sort of price to FFO ratio, sort of like a price to earnings ratio for valuation. And over time, we sort of see this line increasing. So the company tends to be growing. Now, this is only the last 20 years. They do have a multi-decade success and track record in this way. And I've taken the prices off this chart because I want to just have a look at the overall trend here. Now, the other thing to note here as well is the white line here representing dividends. So this is a dividend to FFO payout ratio. And it seems to have been clustered in recent years at about 80 percentages, with the exception here post-COVID with some difficulty, but improving here. And it looks like substantially better potentially going forward. Now, really quick look here then before we put prices on, an analyst scorecard check. So look, in terms of FFO, a perfect rating here. The company both provides, I think, very good guidance when you look at what they tell analysts and the public. And also they're very, very consistent in terms of their growth and reaching those objectives and expectations. Historical performance, I think, is also worth looking at. So the dividend per share, the dividend growth here, I think is important as well. We can see that there's been a couple of big bumps from time to time, but in the last decade, it's been sort of 2, 3, 5, 4, 3%. So, going forward, I think we could probably look at a dividend increase of maybe sort of 3 to 5% seems reasonable per year on top of a share price of the 5% at the moment. Now, an overall performance in terms of comparisons with the S&P 500, it looks like the compound annual growth rate has been about 9% over this period compared to S&P's 8%. So overall, this does look attractive in terms of overall growth prospects. So you're probably not going to lag the market. And probably most importantly here as well as the total dividends being substantially higher than what you would get from the ETF over this period. Forecasting calculators. So I'm going to switch to the normal multiple, which has been quite high at about 20 times in a price to FFO multiple. If we do manage to achieve that by the end of 2025, if prices reach this multiple and the analysts get the estimates right for the FFO, you could potentially from this point see a total rate of return of 60% plus, which is almost pushing 20% rate of return, annualized rate of return per year. Now, also we're looking at this, we can see in general the analyst expectations here have been revised somewhat down for 2023, but somewhat upwards in 2024 and 2025 over the last 6 months. So in the last 6 months, the analysts have been increasingly bullish about the prospects here. Okay, I'm switching over now to the ticker terminal. This is a platform I use because of the beautiful depth of data that it has available, drawing from the data source S&P Global and Capital IQ platform. So I've got here pulled up Realty Income Corporation. One of the things I just wanted to look at here is the number of recommendations here and how this has sort of changed over the last 6 months. So we can see that the overall number of buys has been decreasing. The number of holds has sort of increased a little bit, and outperforms have sort of increased a little bit. So it looks as though the analysts are becoming a little bit less excited about the prospects of the company here. Another point I want to have a look at is, historically, sort of what has this looked like in terms of the price to the net asset value, as the estimates, the underlying asset values here? So we can sort of see back at the end of 2022, price was about 22% over estimates for the net asset value. Now it comes down to a closer one-to-one relationship, which seems to indicate this may be a better time to buy. Now I'm going to switch over to Agree Realty Corporation now, looking at the same chart here. Over this period here, the number of buys, but you can sort of see that it's just accidentally plotted it there. And since I'm plotting it, I may as well plot all of them. We can see that the number of buys here has sort of decreased a little bit, and the number of holds has been a little bit static, but has been increasing this year as well, as the number of buys has been decreasing. So that's important to keep in mind as well, I think. One of the other points here as well is that about end of 2022, the price to net asset value here as well was looking at about a 1-to-1. And now the price actually looks a little bit higher here compared to those net asset values for the company. So in contrast to the Realty Income, I think here the net asset value and the price seems to be heading in the opposite direction, suggesting that ADC is a little bit perhaps overvalued compared to the underlying assets that they hold. Now I want to just do a quick comparison here as well, looking into the future. Now what I've done here is I've taken the chart here, I've got both Realty Income and I've also put ADC on here as well, Agree Realty. Now what we have here is the percentage per share dividend change, and as we look at this over time, so we're here at about 2023, and looking out for 2024, and we can sort of see here in orange that in 2025, 2026, analysts are expecting the percentage change for ADC to be lower than that of O. So we can see here the grey line here seems to be slightly higher, seems to be suggesting that analysts are expecting, again, what we might expect from Realty Income is a consistent and reasonable increase in the dividends over time. I'm going to take these off, and I want to just have a look at what analysts are expecting the adjusted FFO changes to be over time as well. Now we can see here in green, again, a fairly consistent performance here by ADC, and here in blue, a bit of a bump in 2022, and then decreasing a little bit as well. This is, I think, somewhat expected when you look at the share size of Income Realty. They're big. It's hard for them to push the needle. It's hard for them to change that adjusted FFO. So in this case, ADC is smaller, and it's going to be possible for them to grow adjusted funds from operation faster going forward. And that's sort of what we're seeing here as well. Now, as a final sort of check, I just want to have a quick look at what the analysts expect. So I'm turning here to TipRanks, another service. TipRanks is fabulous because they focus on analysts and analyst expectations. I'm going to switch to Realty Income first of all. I'm going to select here the top analysts. Now, what this means is we're going to see the stock forecasts and the price targets from the top analysts that are consistently outperforming the market. Now, this is looking at the current prices, and we're looking at the high then of about 71 estimate, an average of about 69, and a low of about 66. And so we're looking here, the top analysts are expecting about a 12% upside from the current prices. Now, if you compare that to ADC, again, looking only at the top analysts, I am looking here at, again, a high of 81, an average of 76, and a low of 73, compared to the current price of 76. Now, it's important to note that the lowest price target here from a top analyst is actually lower than the current prices, and that's something that might give you a little bit of a pause there, but the top analysts are expecting a 14% upside from the current prices. Now, it's entirely possible that still you think that this may be too much risk. There's good news for you. Not only are there common stock options, there's also some preferred stock options. Now, if you're not familiar with what preferred stock means, it means that you're more likely to be paid out. Now, traditionally, the preferred stock is issued at a lower dividend rate for you. However, in this particular case, because of some interesting mechanics here in the market, I think there's a really interesting opportunity if you like the look of the Agree Realty Corporation. Now, I think if we look at this, there's a good combination here of low risk as well as reasonably good dividend yields, as well as upside capital appreciation. So let's have a quick look at that now. So look, I think we've got some really nice opportunities here with the preferred series from Agree Realty Corporation. Now, this was issued at 4.25%. Now, there's a couple of things to note about this. Number one, look, this is low. In fact, that's the lowest for any REIT that's been able to issue these preferred securities, I think. Very close to the lowest level. Now, what this means is it's a testament to the strength. So essentially, they're able to issue these preferred shares at a low interest rate. And investors are prepared to accept that because they see the security and the safety of investing in ADC. And so that's actually a sign of the strength of the organization. Now, on the face of it, it seems low. It's lower than the common shares, which is what we would expect. Now, the really important point here to note as well is the yield currently, if you buy now today, it's actually sitting at 5.9% almost 6%. That's because the shares were issued at $25 and 4.25% on $25, but the value of the shares has decreased as inflation has increased and overall interest rates in the market have increased. The value of these shares has decreased accordingly. Now, over time, as inflation comes under control, as interest rates begin to decline a little bit here as inflation becomes under control, the value of these shares should increase. They should come back to about the $25 level. So this represents, if you buy now, I think some really nice long-term yields and the opportunity to benefit from capital gains as these preferred shares are revalued as the market changes. So let me know what you think. Is this interesting to you? Is this a really good opportunity? Do you invest in preferred shares, or do you prefer common stock as your number one go-to? Let me know in the comments down below what you think.